Right, no fluff. Let's just get straight into it. Morgan, you're the chart wizard. Every Tom, Dick and Harry in trading talks about, well, moving averages. For the person at home just staring at a load of green and red squiggles thinking, what the hell is this? Break it down for us. In plain English, bruv.
Sound. Think of it like this. You look at a chart for, I don't know, Bitcoin, yeah? On any given day, it's a miss. Jumps up, crashes down, pure chaos. Most of that is just market noise. It's like static on the radio.
Right.
It doesn't actually mean anything. So a moving average is the tool that tunes out the static.
Okay.
It just calculates the average price over a set period, say the last 20 days, and draws a single, clean line on your chart.
So it's basically an Instagram filter for ugly charts.
Yeah,
It smooths out all the rubbish so you can see what's actually going on.
exactly that. It turns the chart's panic attack into a smooth wave. You instantly see the real direction. Are we going up, down, or nowhere fast? It's your first step to not getting faked out by every little price spike.
Okay, sorted. But then you get all this alphabet soup. SMA, EMA, I hear there's even a WMA for the proper nerds. Are that all the same or what? Impatient. Spill the beans, Morgs.
Nah, they've all got their own personalities. Let's start with the OG, the simple moving average, the SMA. This one's the old-timer, right? The dependable granddad. For a 20-day SMA, you literally just add up the closing prices of the last 20 days and divide by 20.
Right.
Every day gets an equal vote.
So the price action from 20 days ago has the same power as yesterday's.
Yeah,
Sounds a bit slow, innit? Like it's still using dial-up internet.
it is slow, and that's its strength and its weakness. It won't get faked out by one crazy day,
Right.
which makes it solid for spotting long, proper trends. But for short-term moves, useless. It will show up to the party after the music stopped.
All right, so the SMA is the boomer of indicators. Got it. What about his cooler younger cousin, the EMA?
That's the exponential moving average. This one, it lives in the now. It does a clever bit of maths that gives more weight to the most recent prices. So what happened today and yesterday matters way more than what happened 3 weeks ago. It's like in your group chat, the last message is what everyone's reacting to, not some dead meme from last month.
Ah, so the EMA is for the impatient ones, the ones who want to know what's happening right now.
Yeah,
I like the sound of that, but does it get a bit too excited? A bit of a hothead?
it can do, because it's so responsive it can jump the gun.
Okay.
It might see a buy signal that turns out to be a total fake out. It's faster, but you've got to handle it with care.
Right.
It's like a high-performance car. Great if you know how to drive it, but you might crash it if you're a lemon.
Love that. Okay, so before we move on, what's this last one, the WMA? This is deep in the CMT textbook, isn't it?
Yeah, this is the one they test you on. The linearly weighted moving average. It's like the EMA's nerdy overachieving sibling. It also gives more weight to recent data, but in a very strict, straight line. For a 5-day period, day 1 gets a weight of 1, day 2 gets 2 all the way to day 5, which gets a weight of 5.
Wow.
It's super precise.
All right, Professor Morgan, calm down. Sounds a bit extra. Is it just for showing off, or does it actually do a job the others don't?
It's a middle ground. It's faster than an SMA, but generally less skittish than an EMA.
Okay.
Some pros swear by it because it gives a very logical, clean read on recent momentum. But for most people starting out, advisory, stick to SMA and EMA. Get those down first.
Sound advice. Okay, enough theory. This is the big short club and not a lecture hall. How do we use these lines to actually make some P's? What are the practical, street smart plays?
All right, play number 1, the golden cross and the death cross. This is bread and butter. You put 2 SMAs on your chart,
Yep.
a short-term one, usually the 50-day, and a long-term one, the 200-day.
The 200-day, that's the big one everyone watches, right? The one that represents the really long-term health.
That's the one, the big daddy. Now, when your little 50-day line crosses above the big 200-day line, that's a golden cross. It's a massive bullish signal. It basically says the short-term momentum is now so strong, it's taking over the long-term trend. The bulls are in charge.
So that's the cha-ching signal, and the opposite is the, oh, crap signal.
Exactly. When the 50-day crosses below the 200-day, that's your death cross.
Okay.
It's a major warning sign. It says that the recent weakness is serious and a long-term downtrend could be starting. It's a signal to be cautious, maybe take profits or get out.
So it's a lagging indicator. It tells you what's already started, but it confirms the move is legit.
Exactly.
You've got it. It's confirmation that the big money is shifting direction.
Right. Don't trade on it blindly, but definitely pay attention. The second play is using the line itself as a bounce zone.
What, like a trampoline?
Literally. In a strong uptrend, you'll see the price pull back, hit something like the 50-day EMA, and then bounce right off it and continue higher.
Ah.
That moving average is acting as dynamic support, a moving floor. If you see it bounce cleanly, that can be your entry point.
And in a downtrend, it's a ceiling. The price tries to rally, hits the line, gets rejected, and falls back down.
That's resistance. See? You're a natural. That's it. Trend direction, crossovers, and support and resistance. That's 90% of how people use them.
Sick. So to wrap it up for the people, moving averages clean up the chart's messy noise, the SMA is slow and steady, the EMA is fast and furious, and you use them to spot the trend, watch for crosses, and find places to buy the dip.
Nailed it. Just don't get married to one. Use them together. See what story they're telling as a team.
Perfect. Right, if your brain isn't completely fried from Morgan's maths lesson and you actually want to talk about this stuff with people who get it, you need to be in our chat group. We take the mickey, we roast bad trades, we share good ones, and we have a proper laugh. The link's down below. Hop in and say hello.
Don't be a stranger.
All right, that's us. We're out. Now, here's a question we'd like you to think about. We've talked about how moving averages are lagging indicators. They confirm what's already happening. So is relying on them just driving while looking in the rearview mirror? Or is it the smartest way to make sure you're on the right road? Have a think on that.